The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether or not your decision is appropriate for you. Property Investing Matters is brought to you by Destiny, empowering investors to achieve success through property investment for more than 24 years.
Hello and welcome to a very special episode of Property Investing Matters. I'm delighted to be able to bring to you someone who is not only a great friend but a valued mentor of mine for many, many years. Joining us tonight from Brisbane, Noel Whittaker. He's a writer and a newspaper columnist and one of Australia's most well-known and respected financial commentators. He's written 22 books, including Making Money Made Simple. He writes columns in major Australian newspapers, including The Age, the Sunday Mail, the Sydney Morning Herald and the Sunday Times in Perth. He also writes for magazines and broadcasts on the radio, and for 30 years he was the director of financial planning firm Whittaker McNaught. Tonight, Noel is going to answer a long list of questions that I've prepared for him, and great timing too with the recent market turmoil. Let's welcome Noel to the show. And hi Noel, how are you going?
Thanks, great to be back with the old team again. So
I know, right? We've
it's been a while, thanks to COVID.
Yeah, and we've certainly, you and I have known each other for a very long time now. We've had many a wonderful debate about the old property versus shares argument. And I think, one time one of us will win a round and then the next one wins a round, and it's back and forward. And the last couple of years are showing us that, it's not about what's best, it's about timing and a whole pile of other things. So I'm going to get straight to all of my questions for you tonight. I've got a lot, as you know.
Okay.
But let's start talking about the recent market meltdown. What happened and, how can we better understand what's happening?
Now, are we in the market meltdown in shares or the coming market meltdown in property?
Well, let's start with the share meltdown.
Okay. The crazy central banks around the world have been printing money like it's going out of fashion. When I was doing economics years ago, they said if you live on an island and the currency is shells and you double the number of shells and there's no more goods and services, the price must double. So we keep pumping all this money into the economy, prices go up. So it's a consequence of stupid central banks. There's no reason why interest rates should be so low. In Norway and most places, interest rates are still negative. If you buy a house in Copenhagen, they pay you the mortgage payments. Still, today. It's crazy. So we've been on the hangover, drink. Sorry, we've been on the party, drink. Now it's the hangover. Boom and bust,
So, we've been in this low interest rate environment for quite a long time now. What is it that makes a share market suddenly have such a big meltdown? I know I've got not many shares, a few, but they've certainly, lost a considerable amount of value in the last week.
Yeah.
What makes that happen?
It's just market sentiment. And there's also traders. When the market crashed about a week ago, the 116 top companies in Australia all lost value. That's your BHP, Telstra, Rio, JB Hi-Fi, Harvey Norman, you name it. But those companies all suddenly didn't start to go bad. I think one of the basics is the price of a share does not necessarily reflect the value of the company. But the great thing is that, it'll bounce back. The great thing about property and shares is they bounce back.
So just to go back to what happened, one day everything is looking great and they were going up and up and up. Within a day, it's a big sort of bloodbath. What exactly makes that happen? And I know we often follow other share markets, but what makes the first share market suddenly get spooked and crash like that? What's I guess the physical process that causes that to happen? Because remember, you're on a property show now, and we're trying to get our
Yes,
viewers to understand what this
sure,
is all about.
sure. Look, there's a thing called the curse of liquidity. The great thing about shares, as we've debated, is if I've got $1 million of shares and you've got $1 million property, if I need 50 grand, I can sell 50 grand's worth. You can't sell the back steps. So because shares are liquid, their price can go like that. But I mean, I think the superannuation funds are now $4 trillion. There's still a lot of trillions there left.
What was the thing that made this happen this time around? What would you point to as the one thing that made this particular share market crash?
Okay, I guess what drives shares is the potential profits of the companies in the index, like your Woolworths, JB Hi-Fi's, you name it. They kept saying in America they would wind up interest rates. If you wind up rates, you take away purchasing power from people. I mean, I've got shares in Zillow. Zillow was at an all-time low. It's the major real estate company in America because American real estate transactions are forecast to plunge. So the more rates go up, the more sellers get in trouble, or certain sellers get in trouble, the less money you can borrow, and it all carries on.
Yeah, so I guess, we can point fairly heavily to the 75 basis point interest rate rise by the Federal Reserve in America as being something that then spooked people into believing that the share market would go down, and so that becomes a self-fulfilling prophecy with people who may be closer to retirement, who need the money. They're too scared to hang in and wait, so that's when we start to get that sell down.
Sure, it's the same with property. When a property boom starts, they all want to jump on the bandwagon. When the share market boom stops, they all want to hop onto it. It's like this Bitcoin stuff. Once things start rising or falling, they all jump on the bandwagon.
Noel, this is probably a question that you can't answer, but it's definitely one that
That's
gets
an awful
asked
way to start a question.
It's definitely one that gets asked of me all of the time.
Yeah.
And I guess based on history and your gut feeling and a whole pile of other things, what do we expect to see with this share market? I mean, if you look at your share portfolio today, you've definitely lost a lot of money. How long does this kind of a loss generally last for? And what do you expect to see in terms of recovery of the share market?
It's a bit like asking a farmer when the drought's going to break. I don't know when, but I know it will. And the Australian share market over 120 years has averaged 9% income growth. It's the best performing share market in the world. And if you've got good shares, not like the index, because the index can't go broke, you're still getting 4.5% franked. So the fact that your money is going up and down, the value, you're still getting the income anyway. You just look, it's a 7-year thing.
And I think that is probably one of the things that a lot of property investors don't understand about shares. And that is that in addition to the fact that the share has a price that goes up and down, but most shares will bring with it a dividend as well. And if that dividend is a solid dividend that keeps coming in, which will happen with a solid company that backs that share, then you do have that income to consider as well.
Yes, plus there's no maintenance or land tax or insurance or that kind of stuff. But if property could be sold on a day's notice, it'd fluctuate as well. And I think that's what keeps property stable. And also if times are tough, people who have property just tend to sit because when all the wise heads get together, we all say, gee, if we only still had all the property we've owned in our lifetime. I reckon I'd be a billionaire nearly.
Same.
Might be close to it.
Noel, at the top of the show, you said Which market are you talking about? Are you talking about the share market or the property market?
Yes,
Which means
yes.
to me that you're expecting that there's going to be a meltdown in the property market as well. Can you just outline that for me?
First of all, I think people should understand, and the press doesn't, there is no such animal as the property market. There's units, there's apartments, there's Cairns, there's Quilpie, there's Point Piper, there's Perth. I mean, which market do you mean? I mean, property in Noosa is going crazy right now. The place that was 6 million last year has just sold for $18.4 million. It's crazy there. So it depends on the market you're talking about.
Okay. Well, let's talk about the Queensland market then, which is one of the markets that
Which
is
part of the
still.
Queensland market? Now, you mean
So,
my house? Go on.
so the Brisbane market at the moment is still climbing and doing quite well in comparison to Sydney and Melbourne, which have turned the corner, and Sydney has now recorded 3 consecutive months of value loss in the overall Sydney market.
Yeah. Right.
Adelaide and Brisbane still showing signs of growth. I guess there's a lot of factors behind that, including the fact that they are more affordable markets. They were a little later to the growth party than Sydney and Melbourne. They were less hot during that phase as well. Do you think the Brisbane market will continue to have a little bit of steam?
I think the big factor in the Brisbane market is the Olympic Games coming. Everyone's now talking about the Olympic Games. Now, I know it's 9 or 10 years away, but I think that's one of the main drivers.
Yeah, in addition
market.
to affordability.
And people like to come to Queensland. It's a great place to live, Queensland.
Yes, they do.
Try it.
Although, we've just come off about 7 years of stunning growth in Tasmania, and certainly...
Tasmania?
Tasmania.
Wow.
Hobart is now the 3rd most expensive city to buy property in Australia, and the growth in Tasmania has been just unprecedented and isn't backed by anything that you would think normally drives a property market. Like, it hasn't necessarily been backed by industry, it hasn't been backed in recent times by affordability. It's certainly not a nice warm place to retire to, but we've seen it really go up and up. We often don't have an explanation for why individual property markets do go up like that. I guess just like we don't always have an explanation for why an individual share will do so well.
I think it's a bit like, I think property and shares are similar in this way, that if a share gets hot or property gets hot, people just hop into it. I remember I think it was not PayPal, the other share that were taken over by Square.
Stripe?
Yes. Okay, it's going well, bang, bang, bang. And then we may as well have some. It's on the way, go.
Yeah, absolutely.
That's why I like the index. Sorry, go on.
Yeah, I think too with a share, if someone said to you, oh, look, this share's going to go really well, pretty much anyone can go, well, I might buy some, whether it's $100 worth or $1,000 worth or $10,000 worth. Pretty much most people could say, well, I can afford $100, let's give it a bit of a punt. Whereas with property, if someone said, well, Noosa is going to go really, really well, not many people can go into Noosa and buy a property hoping to ride that wave.
Sure. But also, when we had COVID and the big sporting games were cancelled in America, all the people who like to bet on the games discovered Robinhood. And they actually just gambled on the share market. And that drove some of these prices crazy. They were just gambling.
Absolutely.
And I think you've got to say, am I an investor or a trader? If I'm a trader, it's bang, bang, bang. Investor, just long term. And same with property, I think.
Yes. Noel, during times of uncertainty in the share market, who is the most vulnerable?
Those people who should be investors, but they call themselves traders. They act like traders. I'm hearing all the time, I think the market's not right, I want to get out and come back when it's got back. Well, you'll miss it because it'll turn so quickly and so high that you'll miss out. So it's people who should be in there for the long term, but they're actually acting like traders.
Yeah, yeah. It's interesting you say that. I know that I'm in a particular fund that
Yeah,
during when COVID hit, and I didn't have a lot of money in it, but I had some money in it. And when COVID hit, it literally halved in value.
yeah,
And
yeah,
then within the year after that, it had gone up so much that I could almost not see where that all came from. And
yeah,
now that I've had something like 25% wiped off that fund, I had to
yeah.
remind myself that the amount that's been wiped off it at the moment is only the same amount that was wiped off when it halved. And it
That's
only
right.
took a year and suddenly it was way ahead again. So
Exactly.
yeah, I have to
Exactly.
sit in that and wait.
I think so. Um, as long as the company's good.
Absolutely.
Because we all have this psychology stuff. I mean, and I've got it myself. If I've got something that's showing a loss, I can't sell it. But if I've got something showing a profit, I might sell that. Now, that's crazy thinking. The fact that something's less more than I paid for it does not make it bad. And the fact that something is now worth more than I paid for it doesn't make it a good long-term hold either. That's the whole trouble. Not easy,
Um,
Margaret.
And Noel, one of the things I find with a lot of people is that not only do they not really understand superannuation, and they can't be blamed for that. There's certainly, it can be confusing. There's been so many changes to superannuation rules over the last 20
Yep.
years that it's not funny. But most people think that superannuation is an investment in and of itself, which of course it's not really. It's where that
No.
super fund invests that's the investment.
Yes.
What can people expect from their super funds at the moment?
Well, the papers are having fun. Like 80 billion wiped off your savings. Now, if the pot's 4 trillion, 80 billion is nothing. But superannuation is not an asset class. It's a structure in which you hold assets like cash, property, shares, bonds, and property. So it's a structure. And that's all it is, and it's the best way to save there is. You can put in $27,500 as a tax deduction. How good's that? And also, if people now are 50, say, one of the major goals is to come to retirement with no mortgage. I keep being asked, should I focus on the mortgage on my super? Well, mortgage payments on your house come from after-tax dollars. Superannuation up to 27.5 comes from pre-tax dollars. And a good superannuation fund should be doing 8%. Your mortgage rate shouldn't be more than 4. So it's a no-brainer to focus on your super with the goal of having enough money in your super when you retire to pay the mortgage off. But then if you're very smart, you don't pay it off. You take off enough for the mortgage payments and let the superannuation grow and grow and grow.
Well, that's a very simple little piece of advice that makes an awful lot of sense, I'm sure.
It's
Let's,
huge. It's huge.
yeah, it does.
Well, just say
Let's,
if you've got a debt of $200,000, your superannuation is say five or $600,000. It should be growing at 40 grand a year. Why would you take out the $200,000? Just take out the interest and let it grow and grow and
yeah,
grow. Yeah,
absolutely.
yeah.
No, let's turn now to something else, which I don't often talk about on this show, and that's gold and silver and precious
Oh God,
metals.
yeah, yeah.
They seem to be quite stable at the moment while the share market's fluctuating. What's your comment on that?
I don't get mixed up in commodities. You can say gold, silver, platinum, pork bellies, you name it. I do say if you buy gold shares and you've got the income and no storage costs. I mean, Warren Buffett says that gold is crazy, and I agree with him. I've never had any and I won't touch it.
Okay, well, that puts an answer or an end to that question.
Well, I mean, it doesn't produce income. If I've got shares, at least if I've got gold shares, I've got a gold interest and I'm getting frank dividends out of it, but not actual gold.
Yeah,
That's the first thing. But
definitely
once again, if you
makes
go for
sense.
gold, you're picking a sector. And I think it's too hard for the average person to pick a sector, which is why I like an index fund. Then you've got every horse in the race.
Okay, so
Can't go wrong.
that brings me to my
Yeah,
next question,
I
which
know.
is where should people be investing at the moment? And you're saying index funds. If you can you explain that to the viewers what an index fund does?
Yeah. In an index fund, the top 200 stocks are really the whole share market. There's a couple of thousand shares that don't trade. The top 200 or 300 is 99% of the share market. Now, instead of trying to pick winners, I'll tell you what, I've picked a lot of winners and I've picked a lot of duds. You just buy the whole parcel. Then you've got your Woolworths, Harvey Norman, JB Hi-Fi, Rio, BHP, everything. They can't go broke. It'll pay you 4.5%. And then you've got no decisions to make. Because people like to pick winners and say, gee, I'm doing well. But it's too hard for most people. The
Absolutely.
index, if I would have, I've got a self-managed super fund. If I would have put that in the index 10 years ago, it would now be double what it is now. That was a big decision because I've been doing this and doing that. No good.
Okay, so
See,
index funds.
the average person doesn't have the skill to pick shares. I'm,
Absolutely.
I'm on the board of a listed company. We've got $6 billion invested. We've got a team of guys picking those, a big team of full-time professionals picking those shares. And we still get it wrong sometimes.
Yeah, that's very true. I'm
Yeah.
almost too scared to ask the next question because I know what your answer is
Ask
going
me
to be,
anything,
but
Margaret.
I'm going to ask it anyway. What's your impression of the crypto market?
Well, if I'm buying property, I can make a decision like, is Brisbane a good place? Is Hobart a good place? Is this a well-built house? If I bet a share, I can think, well, if I'm thinking about shares, well, I like the management, I like the company. The only reason I buy cryptocurrency is somebody will pay more than I'm going to pay. I used to write about Bitcoin a couple of years ago and I'd be attacked in the press. You're an old-fashioned idiot. It's going to go to $300,000. This weekend, it's just tumbled. It's wiped out. And there are over 1,000 cryptos anyway. To me, if you want a punt, have a punt, but it's only a punt. That's all. Look, I don't mind a punt if you know it's a punt. That's all.
Yes.
If you want to have a punt, that's all.
And I think
Punting's
that's
fine if you know it's a punt.
I think that's the bottom line, is it? That if you want to be the kind of person who speculates, then you should be doing so only if you understand that there's always the chance of all the money being lost and you're okay about that.
Yes. And Bitcoin, don't forget, there's a case right now in Hong Kong. The guy left $80 million and died, but they can't find the password. It's gone. Not for me, Margaret. I'm a good old property and share man. I like it simple and I like to know what I'm talking about.
Absolutely. Hi there, I'm Margaret Lomas. Buying an investment property isn't about finding something that looks good and thinking that it will make a good buy. It takes years of experience and countless hours of research to identify an area that'll perform well and a property which is right for your circumstances. Let me introduce Property Match. It's a revolutionary new system which uses machine learning and our 25 years of experience to find your next investment property. Head to our website mypropertymatch.com.au or give us a call at Destiny to find out more. And let's move to interest rates. Do you have a comment about what you think is going to be happening with interest rates?
Well, I think the Reserve Bank, I think the cash rate will be 2.75 to 3 very shortly. They just have to. which I think mortgage rates will be 5-6%. That's my view anyway. Yeah. Yeah.
And we all remember a time when if you had a 5 or 6% mortgage, you were over the moon and happy because you'd come off 18 and 15 and 12 and 8. And so 6% was a great mortgage rate to have.
Yeah, but of course things were dearer. But still, I bought a unit at Mermaid Beach in 1990 and was thrilled to get a 15% fixed rate. But when I wrote Making Money Made Simple back in 87, they were the days when things weren't woke, you know. And I said, if the average couple on the average wage buy the average house and use all of her wages for 5 years, the house is paid off. Okay? Now, in 10 years, the mortgage is possibly can be handled on one wage. When I started selling real estate back in 1974, the average house in Brisbane was about $30,000 and average wage is 15. So a Brisbane house was 2 years' wages. Now it's about 8 or something. So homes are much more expensive.
Yeah.
That's the point.
Talking about housing now, the Queensland Government has proposed a new system for land tax in Queensland. What do you think that will do to Queensland property? And maybe we can explain first what that new system will be.
Well, as you know, land tax is a state tax and it's levied on the value of your land at 30 June, but it's a state tax. So what many people did was they'd buy one place in WA, one in Victoria, and they'd spread their portfolio to minimise the land tax. Now, what Queensland has announced they will do is when you have an investment property in Queensland, they will add to its value all your other investment properties. And then when they assess it in Queensland, you'll be paying land tax at a higher rate because you're at a higher threshold.
Yeah.
You won't be paying. You won't be paying tax on your other properties, but those properties will boost your Queensland to a higher level, and you'll pay more.
Yeah, pretty
I don't
much.
think the average person even knows about that.
Yeah, it's almost like if you've got a Queensland property, it's just popped on the top of your other properties, and that might push it in to the next threshold. And the way most land tax works is each threshold has a bigger proportion or a bigger percentage land tax required.
I got caught at my beach house because I didn't know, but I bought that in the name of the family trust, and I pay a much higher rate of land tax. That's gone up 40%, and this year the value is up to 40%. So the land tax will be up 40%. I've got the guy emails me every week from Brisbane about land tax. This is his whole barrow. They have it indexed to rates for 12 years. So more and more people are coming into it as property prices rise.
Yeah.
So he's leading a push to index the rates, but, you know, best of luck.
Now, speaking of property and different states, New South Wales has now proposed that people buying property may choose between either an upfront stamp duty or a yearly land tax, with a view to eventually getting to the point where the choice is removed and it's land tax only. So it's a big transition period. What do you think of that?
Well, it's been on in Canberra for, as you know, for quite a few years. I think the New South Wales proposal goes to 1.5 million maximum, I think. I guess really it's probably a good deal for a buyer. But the big question is, how will they fund it? Because a major part of the state government's income comes from one-off stamp duty things. And they've been having a bonanza. So the thing's always been, how will they pay for that?
Yeah.
I mean, also, I think people need to know, I mean, if I buy a house here and choose the annual land tax and the stamp duty, that goes with the house in perpetuity. So when I sell the house, it's got a special value because the new buyer doesn't pay stamp duty either. He's got no election to make. You know, so they're giving up a lot of stamp duty.
Yes,
you know.
it'll be interesting to see how that one plays out. Noel, a couple of weeks ago, you wrote an article for the newspapers on death tax on super funds. Can you tell
Yes,
us
yes,
what that
yes.
means?
Okay, your super fund has a taxable component and a non-taxable component. And most people's funds are mainly taxable because the taxable is your deductible contributions and the boss's contributions and all the earnings. And as your fund grows, it becomes more and more earnings. But you can also make an after-tax contribution up to $110,000. So just to make it simple, if you've got $500,000 in super now, that could be 100,000 non-taxable and 400,000 taxable. You with me?
Mm-hmm.
If you leave that to a dependent and your spouse is always dependent, there's no death tax at all. But if that goes to a non-dependent, and don't forget that when the spouse dies, when you die, the spouse will be leaving it, and the spouse will cop the death tax. It's 17% flat. So $400,000 would cost you $68,000 in death tax. There's a way around it.
Yeah,
So
what's
go
the
on.
way around it?
Well, everybody should have an enduring power of attorney. The enduring power of attorney should be told that as your death gets close, you cash in your superannuation tax-free and put that in your bank account. Death tax gone, abolished. Most people don't know about it.
Yeah, good advice. I'll tell my husband. I'm older than him, so hopefully he'll do that with my super when I'm approaching death.
Well, if it goes to your partner, you're right. It's the next step.
Okay.
Yeah.
Noel, what would you say is the best way to get the most out of your superannuation?
Well, on my website, a superannuation contributions calculator, and you can run your own numbers. But how much you have in super when you retire and how long your money lasts depends almost entirely on the rate of return you can achieve. So your major focus should be the rate of return. Now, I did this on women in super. I went to a women economic seminar on women in super. And one of the reasons women have less super than men, apart from the fact that they choose to be a part-time doctor, part-time vet, and they have broken things, is women are less aggressive in their choice of fund. And the only conclusion after a whole day was that the high growth option for all women under 60 should be automatically high growth unless they opted out. Because that's the major factor.
Okay.
When you talk about retirees, I mean, if you retire at 65, you've got 30 years ahead of you. You can't suddenly stick it all in the bank, because you will live longer than your money.
Yeah, absolutely. Look, I've only got one more question for you today, and it's again one of those ones that a lot of people have opinions on it. The opinions differ. What do you think is the latest wisdom about how much you should have in your superannuation by the time you retire in order to have at least a comfortable retirement?
Well, it depends how much you drink, how much you go out, and whether you fly coach or first class, I guess. I think ASFA thinks about 65 grand a year is what you're going to spend. It's very, also as you get older, you tend to spend less. It also depends on, are your kids asking for help? I think, as I say in my book on retirement, you should you should prepare for retirement by doing a budget and then work out how much you need to make that budget work. And of course, any part-time work's the bonus. If you can get a couple of days work a week, wow, that's so valuable.
Mm-hmm. Yeah, absolutely. A friend of mine...
I also ran some numbers that if you retire at 60, I haven't got that in the head, but basically, if instead of retiring at 60, you go to 65, you'll have 40% more super. Because it all happens in the last few years. So the longer you can stay at work, the better.
A friend of
And then
mine.
if you've got a part-time job, if you got a part-time job, then of course you aren't drawing down so much.
Yeah,
Because how long your money lasts after you retire is how quickly you draw it down and the rate of return.
Yeah, and I guess it depends on if you've got anything outside of super as well. Some people might have a property or two outside of super, and other people might be prepared to take the house that was their family home and downsize into something a little smaller and therefore get some money out of that. There are some rules around being able to downsize and roll some of your money into super, Noel.
Yes, I mean, a couple can put 600,000 of the house proceeds into super. It's a non-concessional, which means non-taxable contribution, irrespective of their age or superannuation balance, because you can't contribute past 75 years of age, and you can't contribute non-concessional if there's 1.7 million there. But this gets around that. And it's starting from 60 on after June 30, and it's going down, to 55 was the election promise. So there's talk about it. But the whole trick is you can now contribute after June 30th. You can contribute up to 75 years of age. And see, if you've got that $500,000 in super we talked about, if you're 69, 70, you could pull $330,000 out and recontribute it, and that will drastically change the mix of taxable and non-taxable.
Certainly.
Also, retirees now also catch-up contributions. Provided your balance at the previous June 30 is under $500,000, then you can use all your unused concessional contributions back to 2019. Now that could be $100,000. So if you've got a couple retired now at 69, they've made no contributions for, they've been retired, and they've got a capital gain to fix. They could, in theory at least, and say, just to make it simple, his superannuation is 800 and hers is 200. He takes 350,000 out and puts that into hers. Then the balances are both under $500,000. Then they can both make a tax deduction of $100,000 to wipe out a capital gain, because that would wipe out a capital gain of $400,000 before discount. That makes sense?
Makes sense.
So you've made a $400,000 capital gain, half each. Discount drops to $200,000. So now you've got $100,000 each. By using the catch-up contribution strategy, you put $100,000 each into super as a tax deduction, capital gains tax gone. That makes sense?
Yeah, it definitely makes sense. And it's
big money in this.
Look, what I think it illustrates, Noel, is that most people don't understand a lot about superannuation, but as you near retirement, it is critical that you do. It is critical that you have an advisor who does, and it is critical that you understand these different ways of being able to not so much manipulate the system, but get the most out of the system so that you can, avoid taxes and you can get more out of your super.
I mean, most people don't know what they don't know. This is the problem. I mean, one of the major findings of the inquiry to super was 80% of people are disengaged. Well, that's got a cost. You're disengaged with your property portfolio, with your super, it's got a cost.
Absolutely.
People need to get engaged. And we're talking big dollars here.
Yes.
Yeah, we're talking $100,000, $200,000. Also, by downsizing, you can lose your pension. A couple could be on be in a $1.5 million house and get the full pension. They downsize to an $800,000 house, and they convert $600,000 of exempt assets to assessable assets and lose most of the age pension. That's another thing. And a topical thing, off topic slightly, If you downsize to an apartment, how will you charge your electric vehicle? It's becoming the real hot topic, because in 10 years we're all going to be driving EVs. Where the hell are you going to charge it? Because most apartments aren't geared for it.
Well, we could probably do a whole episode on the ins and outs of superannuation in different ways.
All this, I mean, there's so much in this, you know.
Yeah,
absolutely. I think both of us are very committed to helping people and doing the right thing by people, you know.
Absolutely.
That's what brought us together in the first place. We were on a cause, remember, to stop property spruikers. And they're still going.
Yeah, I know.
Yeah.
That's a cause that goes on forever, I think. It is going to be a difficult one to get on top of.
I see ASIC yesterday took someone to court because they were flobbing self-managed super funds because property doubles every 8 years, you know.
Yeah.
Maybe it will, maybe it won't.
Yeah. Well, that's another episode, and I think we'll do an entire episode in a few months' time on superannuation and just help
That'll be fun.
To bet. I think that's definitely in order. You know, this is a property show, but I definitely like my viewers to find out more about other asset classes, other ways to invest, and the importance of super. So I think if we did that, that would be very, very beneficial to my viewers. So.
Look,
well,
you need a diversified mix, you know, and that's what you do, you know. Don't chase the rainbow all the time.
Yes, good piece of advice. Well, that brings us to the end of another episode of Property Investing Matters. I'm sure you'll agree that knowledge like Noel's is priceless, and the more that we can get of such great information, the better. Thank you so much for joining us today, Noel.
It's a pleasure.
Now, your website is noelwhittaker.com.au.
With all those great calculators, yes.
Lots to see there. You can, of course, get hold of Noel's books there, and I highly recommend that you do so. Noel, you have a new book as well?
I've got one coming out. The retirement book came out last year. It's going very well. The new book is called 10 Simple Steps to Financial Freedom. It's only 10 chapters. It's designed for 18 or 19-year-olds because, again, they don't know what they don't know. So first basic, you spend less than you earn. That puts you in the top 15% to start with. Everyone's pushing this, get your wages in advance. There's a huge push for it now. The workers are saying it's not fair we wait a fortnight to get paid. These apps let us have it straight away. It's frightful.
Well, it sounds like a perfect book for my viewers to get hold of for their kids, and keep an eye out for that when it comes out. I'll certainly let you all know through my newsletter when that's coming out. You can email me at pim@mypropertytv.com.au or contact me via social media. Margaret Lomas on Facebook, Margaret Lomas Property on Instagram, and Margaret Lomas AU on Twitter. Don't forget to check out my free educational podcasts and vidcasts at destiny.com.au, and be sure to sign up as a VIP at destiny.com.au to receive my monthly newsletter and our weekly property news update. Thanks again to Noel for being with us tonight. You all have a great week, and I will see you back in the studio in a few weeks.
Property Investing Matters was brought to you by Destiny, empowering investors to achieve success through property investment for more than 24 years.
setting and forgetting your property portfolio can be just as bad as never getting started at all. If you're not staying on top of interest rates, loan structures, tax deductions and current rent returns, there's a good chance that your portfolio is underperforming and you're losing money. Whether you have a large property portfolio or you're just starting out, monitoring your properties is just as important as buying them in the first place. Destiny's Finance and Portfolio Monitoring Service will not only oversee your rentals to ensure they're always achieving the best possible return, it will identify when you're ready to invest again and ensure that you always have the best and most cost-effective loan products available. And with more than 25 years of experience and billions of dollars in finance applications completed, you can be sure you're in safe hands with the experts in the business, Destiny.
Go to destiny.com.au to find out more, or give us a call on 1300 My Destiny.